Welcome to Group 3's presentation on measuring an investment portfolio. So today, we have chosen 10 stocks for multiple industries to add to our portfolio, and we have also chosen a T-bill. Portfolio is very diverse, which indicates that it could be risky, very risky actually. The effect of the pandemic hurt some of these companies and have disrupted their stocks. So today, in our presentation, we will see how these stocks have recovered and, if at all, have grown through the pandemic up until recently. In 2020, we've had the most dramatic stock market crash. On March of 2020, around the time that the pandemic started to arrive in the country, it marked one of the most drastic crashes due to COVID-19. It lost more than 6,400 points in less than a week. How did our government respond to the pandemic? Well, in order to combat the slowdown of the economy, government and the Fed adopted monetary and fiscal policies. 9 months later, our stock market bounced back due to government relief. With PP loan, pandemic relief, and stimulus bill, the government have inflated the market with liquid. And also individual investments. An influx of money on people and electronic-based trading made stock market comeback possible.
Netflix is the world's leading streaming entertainment service with 167 million paid membership in over 190 countries. Lately, this company had been crushing the market with the revenue increasing 108%. The stock is at its all-time high. The stock grew 50.66% this year. It's nearly up $100 billion in 2020 alone, making the 23-year-old streaming giant one of the 20 largest companies in the S&P 500. The pandemic created the perfect situation for Netflix company in short term, because millions of people stayed at home and binge-watched their favorite shows, and millions of new subscribers created the perfect storm for the company to rise to the occasion. For the computing and consumer electronics market, AMD designs and creates microprocessors. The majority of the company's revenues are on computer market through CPUs and GPUs. It has a profit margin of 10.17% and revenue increased 43.55% this year. It's outperforming and outpacing all of its competitors. It's leading the charge in the gaming industry against Intel. AMD had a growth projection even before the pandemic. With millions of people in lockdown, the demand for chips and operating system increased. With holiday around the corner, the profit will more likely to increase.
Amazon was among the stocks we had chosen to include in our portfolio. Despite facing adversity from the pandemic, the Amazon stock grew 60%, with the current share price of $3,164. The growth in the stock largely comes from expansive retail store closures that pushed a surge in online sales. And now with the holiday season coming up, this will only accelerate the demand for more deliveries. With an increased demand in online services, Amazon had to hire more employees to keep up, something most companies could not do, as seen by the massive unemployment wave that hit the country. As consumers continue to adapt to the stay-at-home orders, they will become overly reliant on Amazon as their default retailer. Apple was another stock with a large market cap that was chosen to be incorporated into this portfolio. At the end of this year, Apple released a line of new products including 5 new 5G iPhones, 2 new Apple Watch series, and 3 Macs with Apple's very own M1 chip processor. This activity of innovation and execution of never-seen-before technology led to a 50% increase in the Apple stock this year, with revenues reporting around $64.7 billion.
We've also chosen General Electric as one of the 10 stocks to be part of our portfolio today. It is known as the future of the industry. Although the pandemic has hurt General Electric's growth in the following quarters, it is still projected to grow 620% the following year. The profit margin stands at 4.52% currently. The growth comes from their 4 divisions, which are healthcare, aviation, power, and renewable energy, which they are mostly known for. As consumers begin to travel again during the holidays, the aviation industry should begin to grow since many are traveling. and this will help make up some of the revenue that have been lost during the pandemic. Another stock they have chosen for this portfolio is Caterpillar Inc. It is known for its construction, machinery, and equipment. It has been able to push through despite the pandemic. On November 24th, 2020, the company reached a high price of $176.90, its highest since pre-COVID. For the past 5 months, it has shown that it can be a consistent stock. In the current quarter, though, it stands at a negative 44.50% and is currently underperforming. It is currently undervalued by many investors and has a profit margin of 7.60%.
Novavax Incorporated is an American vaccine development company that has made notable progress in creating a potential coronavirus vaccine. Although vaccine bets for COVID-19 continue to be speculative, the economy could see a significant upside if Novavax develops a safe, effective, and relatively affordable vaccine. The company is currently in the trial phase for a coronavirus vaccine with an expected readout in the first quarter of 2021, which is at least 1 quarter behind frontrunners like Pfizer and Moderna. Despite this, the Novavax vaccine still holds promise as data from early trials showed high efficacy rates. Additionally, the vaccine would be easier to distribute, only needing to be stored at refrigerated temperatures and more reasonably priced at only $16 per dose, as compared to the other frontrunners. Novavax was awarded $1.6 billion in funding from the federal government via Operation Warp Speed, giving the company the capital to expedite production and delivery once it receives approval. The stock has soared 2,000% year to date. Shares have surged 37% since mid-November and are expected to climb even higher. Although the company has a beta of 2.08, making it a very risky healthcare stock, we chose this company taking into account the quality, safety, and convenience of its vaccine. Novavax remains a top contender in this market. We've included both AMD and NVIDIA in our portfolio as both companies hold plenty of promise over the course of the next decade and beyond. NVIDIA is known as a market leader in the design of high-performance GPUs, chips, and in recent years has also branched into self-driving cars, corporate workstations, and data centers. In the third quarter of this year, NVIDIA hit record earnings with a record revenue of $4.73 billion, a data center revenue of $1.9 billion, and a gaming revenue of $2.27 billion. A record-setting quarter in the midst of a global economic meltdown is impressive. NVIDIA also announced recently the planned acquisition of ARM, creator of the world's most popular CPU, in addition to profitable collaborations with companies in gaming and automotive industries. With the beta of 1.47, it is theoretically a volatile stock, but the company is expected to increase in its return with the higher risk. NVIDIA will continue to reap the rewards from advantageous investments in new technologies, in AI, and in autonomous vehicles, while simultaneously succeeding in its traditional fears of business like gaming.
Sony is a Japanese multinational conglomerate corporation that focuses on electric products and media. The pandemic forced many to look for other means of entertainment as they were constrained indoors. Sony unveiled the PlayStation 5 on September 16, where soon afterwards, retailers began taking pre-orders and sold out within hours. There have been many restocks afterwards, but they have all sold out within minutes. Sony released a statement on Twitter declaring that the demand for the PlayStation 5 was unprecedented. With this regard, Sony's gaming revenue more than doubled and is expected to make up to 30% of the company's total revenue in fiscal 2020. Sony stock has grown by 33.43% year to date and approximately 289% over the past 5 years. It has shown consistent growth over time, and given how the gaming industry is on the rise, Sony is a good stock for the long term. Sticking to the growth of gaming, another stock that has potential is Activision Blizzard. They are a publisher, developer, and distributor of gaming software and peripheral products. Due to the pandemic, people sought out video games as a form of staying entertained indoors. This not only included people playing, but watching as well. According to Twitch and YouTube gaming statistics, there were more than 2 billion hours of gaming watched in April. For the third quarter this year, Activision reported a 52.4% year-over-year increase in their net revenue as their net income tripled. In addition, they also showed a 200% earnings per share growth in the latest quarter, which means that they are growing and generating money that could be reinvested. The gaming industry is growing, and this is shown with the rise of competitive play and esports. There have been universities offering scholarships and degrees in this field. Activision stock has real potential due to the direction of the gaming industry. Furthermore, they have shown that they can adapt. In September 2018, they hit a record high of 84.68, later on to crash to 39.85 on February 11, 2019. Then they rebounded strong this year by setting an all-time high in August.
Alright, now that you have seen our 10 stocks that we have chosen for this portfolio, here you will see our Excel work. We calculated the expected return and the standard deviation for each of the 10 stocks, and we've also included our 13-week T-bill. The data is based off a 5-year, 60-month monthly scale using only the adjusted close data from Yahoo Finance. As you can see from the chart, General Electric has a negative 11.51% expected return, while with the most is Novavax with 2,428.28% of its expected return. It's pretty large, isn't it? Here you see our correlation and covariance calculations. We first found the correlation for each of the 10 stocks that we chose. As you can see in the first table, from the top left all the way to the bottom right, all the ones right there mean that it is perfectly correlated. We then found the covariance for each of the 10 stocks with the help of the correlation. In this next slide, you will see the global minimum variance portfolio. Here you can see a portfolio variance of 3.12%, a standard deviation of 17.67%, and a portfolio return of 13.81%. You can also see the weights of the stocks, and you can also see the covariance table that we had from the help of the portfolio weights. On this slide here, you will see our risk-return trade-off mean variance efficient portfolio. Here, it is slightly different, the portfolio variance. It is now at a 3.53%, while the standard deviation is a little bit higher than before at a 18.79%. But the portfolio return is larger than the other one. It is now at a 22.98%, and our target return is at a 25%. You can also see the different weights we calculated for each of the stocks, and you can also see the different weights we have chosen for each of the stocks and the covariance table that comes along with it.
After doing some calculations, we were able to obtain various data points on the expected return and volatility of our portfolio, which allowed us to plot our efficient frontier in addition to the capital allocation line. Upon analyzing the different weights of the stocks in our portfolio, the one that gave us the highest Sharpe ratio was AMD at 47.7%, Novavax Inc. at 0.57%, and Nvidia Corp. At 51.73%. This gave us an expected return of 114% with a volatility of 43.70% and a Sharpe ratio of 2.58. Our efficient frontier is shown by the blue plot, while the orange plot represents our capital allocation line with respect to the current risk-free treasury rate. And then the red plot is our capital allocation line with respect to the 13-week T-bill that we chose. Upon calculating the optimal portfolio allocation, assuming a risk-averse level of 4, we got an optimal weight on a risky portfolio of 41.80%, leaving 58.20% on our 13-week T-bill. The expected return and risk on the entire portfolio would be 95.42% and 18.27% respectively. The Sharpe ratio would be 0.7307, and the value at risk shows a 7.1% potential loss from a negative event.
So from our calculations on the 10 stocks and the 13-week T-bill, we have come to conclusion that this portfolio will come with a high expected return, but it will also come with a high risk. There is only approximately 7% of a loss from a negative event. Thank you for listening and watching to our presentation.